right. Good morning, everyone. How are we doing today? So sorry for the technology hiccups. I've decided to do this from my phone, which means probably the video quality is a little bit better, but my ability to go back and look for comments and questions will be less than easy, given my real estate is very different, but I will do my best. It's important for me to answer all questions that I can, so I will do my best to do that for you this morning. I may ask you to list the questions time and time again, so just realize I'm doing the best I can this morning. Just know, as I've mentioned in the first two videos, I had a technology consultant who's actually a subscriber to this channel meet with me Friday morning. We reviewed my technology setup in my office, where my Wi-Fi router is, all of those good things. So he has made some recommendations for new hardware to buy, which I have, and all the components will be here by Thursday. So hopefully this is the last weekend where we have these technology hiccups. Again, making an investment to do this a little bit better. So we'll see what happens. So again, realize that this question and answer session is here for you. I'm doing the best I can to help you be a little bit better every day, myself included. I do all of these live. As you can see, this is the third time we've tried to do this morning. I apologize. I will delete the other two streams or whatever they are here in a minute. But again, we're going to go through your questions. I appreciate that this took a little while to get started. I apologize. But let's get started and let's see if we can't make the best use of our 45 minutes together. So I'm going to go through the questions I had. Again, I talked about this in our daily financial news that went live. The first one is it now the time to hoard cash? And when I think hoard cash, again, it's hard for me to appreciate the other person on the other side of the question. That's why I like the live chat, because I can go deeper. When I do these live streams, I can only look at these occasionally. So I can't really go deeper. But when I think about hoard cash, a couple of things come to mind. First and foremost, when I hear hoard cash, I generally think that person on the other side is a stock market investor. And well, all I can say is if you've been following my channel for any length of time, I'm a terrible stock market investor. As many of you like to remind me, I'm an emotional trader. I watch it every day, every minute, and that's not the way to be an investor in the stock market. But that is, that's just who I am. So I realize that I can't do that. But if you're thinking about hoarding cash in real estate, this is a conversation I could have. And what I would tell you is it really depends on what you see coming in your market. I've done some quick math for you. And yes, I know lots of people are talking about a crash and a lot of these scary things, but I want you to do some math. And I've done some quick math, and I've talked about it many times. In my opinion, the thing that could hurt real estate is a rise in interest rates. It's not about price. A lot of these new YouTube entertainers want you to believe because we are at or above the '08 peak that we're in a bubble. And that's just not true. Mortgages are generally done on payment. And when you have an interest rate at 3%, and then 10 years ago or 12 years ago was at 6%, the payment is very different. But let's talk about it. Let's assume you think real estate's going to go down 15%. Anything's possible. Maybe. I would argue if real estate goes down 15%, interest rates have probably gone from 3 to 5%. I believe interest rates are tied to the next market collapse or fall or whatever. But I challenge you to do the math. And I did the math on an opportunity. So let's assume you're buying a home today for $350K. And oh, by the way, these mortgage calculators are available on the internet. So it's not like I have some special secret sauce. So, take these notes. You're going to buy a home for 350 grand. You're going to put 20% down, 70 grand. You're going to get a 3% mortgage. Okay, seems reasonable. And it's 3% fixed for 30 years. Your payment on that $350,000 home, $280,000 loan is $1,180. It's simple math. Okay, great. Now let's assume that same home falls 15%. Let's assume that interest rates, 30-year fixed, go from 3 to 5%. Hey, I want a 15% discount on price. If you're a cash flow investor, no, you don't. Do the math. So what I did just to make the math look easier is I took a 350K house down to 300 grand, right? So it's actually 14 point something percent, but bear with me, do your own math. So now that 350K house is worth 300 grand. Same deal. You put 20% down. So instead of 70 grand, you only put 60 grand. Congratulations. But now your interest rate is 5%. Guess what your payment is? Your payment is $1,288. Your payment the first time was $1,180. You got a 15% discount and your payment went up $108. If you're a cash flow investor, you follow one rental at a time, you're going to hold for a long term, it could make sense to buy today if you can get low interest rates. Just do the math, folks. These people out there talking about a crash aren't telling you the full story, or worse yet, are not experienced enough to do the math. It's insulting. The advice is shockingly bad. So again, if you want a 15% discount and feel better about paying $300 instead of $350, who am I to say? But you're going to spend an extra $108, which means your cash flow is less. I'm going to sneeze. So, sorry about that. So again, when I go back to the question of hoard cash, what do you see coming? I would say for many of you that follow one rental at a time, you're yet to get your first or maybe your second or your third. It really could make cash flow sense to buy now. But again, as I talk about my students, learn your market. We talk about national stats. There isn't a national real estate market. There's hundreds of, if not thousands of local markets. That's why you learn your market. You look every day, 10 to 20 minutes a day. You got to do the work. If you're one of my students and you've been at it for probably 3 or 4 weeks, you're starting to see your market change. I actually did a video on Friday, I think. Maybe it was Thursday. It might have been Thursday, where I brought on a Fresno broker, which is the market I watch every day today. And I opened that video with saying, this is what I think the market is doing. And lo and behold, we went through the actual stats and I was right again. This is what happens when you watch your market. You can see it happening before others report on it. That's how you do good or great deals. Okay? So that's that question. Number two question I got is I did a video about Rocket Mortgage when they reported earnings. I think it was on Tuesday's daily financial news. And in that talk, I talked about how Rocket Mortgage could grow into, morph into what was Countrywide, IndyMac, and all of these companies that are now defunct, out of business. I didn't really give any history, but let me do that here. So again, if you follow me for a while, you know I've been in technology sales for decades. And I actually called on Countrywide, IndyMac, and sold them software back in early or mid 2000s. So one of the things that you see when you do that is you see what's going on at the companies. So again, Countrywide, IndyMac, all of them were making technology investments. Countrywide was trying to, just like Rocket Mortgage is today, drive loans through the internet. That's Rocket Mortgage's business model, folks. That's, if you don't know, that's what they're doing today. But that was Countrywide's vision. What happened is that platform that they were building became the feeder for Wall Street. Wall Street wanted more and more loans. So just like Rocket Mortgage, Countrywide was just a producer of loans, and they didn't hold any of them. Just like Rocket Mortgage doesn't hold mortgages; they sell them. So realize that that's the business model. And what happened is more and more companies, right? Countrywide did it, then IndyMac, and then all these others were just feeding Wall Street's appetite. My fear is that Rocket Mortgage could be going down that path. Now, let's be clear. They're probably years away from getting there, but when you build a machine where the input is borrowers, you and I, and the output is Wall Street, and you're this little segment, at some point you got to keep feeding the machine. So what does that mean for you and I? What we need to watch is, does Rocket Mortgage start lowering the credit quality? Right now, real loans, 700 credit scores, real down payments, fixed rate mortgages. The loans being done today, near as I can tell, are super safe and legit. But who's to say by middle of next year, late next year, that they're not doing stated income loans, liar loans? Who knows? It's amazing how often we repeat ourselves. So watch for that. So again, I made that comment. Somebody asked about it. I thought I would address it. I don't see them heading there now because the credit quality and loan product is still good, but we should watch it because that could change. There was another question about building a rental portfolio to over 100 units in less than 3 years. This was someone looking at, somebody was basically saying, is it legit? Is it possible? All of that. Again, my story of one rental at a time to financial freedom is 15 years in the making. It took us 11 or 12 years, probably 12 years to get over 100. Is it possible under 3? Yeah, I mean, if you have hundreds, if not thousands of dollars. I've been doing this for a while. In most people that claim over 100 units in under 3 years don't actually own 100 units. Let me explain. Typically, when I see those wild claims and I scratch the surface, what you are finding is those individuals raise capital. They are generally speaking general partners in a syndication. So they may be raising capital, buying hundreds, 500, 1,000 units. So they claim these huge numbers in a very short period of time. But in reality, they own 2%, 3, 4, 5%. So I consider claims like that extremely dishonest. If as individuals going from 0 to 100 in 3 years is, I don't want to say impossible, but is absolutely impossible for the average person. It just takes time, right? We don't have endless capital. We need to save. We need to 1031 exchange. We need to cash out refi. We need time to help us. So my general feeling when I see those claims are, depending on how they're doing it, either they're just bold-faced liars or they're misleading us. So I don't think those claims are legit in most cases. I'm sure there's an exception or two. Maybe mommy or daddy gave you $1 million to go do something. I don't know. Next question I have, again from the daily financial news articles, is did the Fed cause the real estate bubble? And again, I'm going to take this as the real estate bubble in 2020. So, I don't think this question was about '08. It's about 2020. So first, I believe without question, the Fed has caused an asset bubble in stocks. I think the fact that the stock market is at or near an all-time high is a full indication that the Fed's liquidity has caused stocks to rise because there's no place to put the money. Did the Fed cause the real estate market to inflate? Maybe at the margins. I believe what we are seeing today is a supply-demand imbalance that has been exacerbated by a once-in-a-lifetime event. I believe if you go back and look at just the last couple of years, we have not built enough single-family homes. And we certainly have not built single-family homes where people want to live today. What do I mean by that? It takes years to do new home development. And the new home development that is going on today was planned 2-3 years ago. Most of that is in and around big cities. That's where people wanted to be. What is happening today is the consumer is changing. The consumer no longer, at least at the same numbers and percentages, wants to live in the big cities or around the big cities. They want space. They want quality of life. They want cheaper. They want space. So because we are, hundreds of thousands of units behind, the units that we have are in the wrong place. It takes years to build new product in new places. I believe we have simple economics 101. You and I want to buy a home in new places, not the big cities, and those places aren't ready for us. So demand and supply imbalance means prices are going up. Where the Fed comes in is they've obviously lowered rates. They are the buyer of mortgages. FHA is dominating the market today, which is a risk in the future, in my opinion. But no, I do not blame the Fed. They have been a little bit of the gasoline, but again, I think it's lack of building is the reason. I think the spark was the health crisis and millennials going from Class A renters to owners in the suburbs. And then the gasoline probably is the Fed, right? Lowering rates, being a buyer of mortgages and things of that nature. So no, I don't think the Fed caused the 2020 real estate bubble, if you want to call it that. I don't think it's a bubble, but that was the word you used in your question. Next up was a topic about deflation. Somebody was concerned about artificial intelligence and robots and automation and all of that. I think that's been I've been in the Silicon Valley nearly 5 decades now. I think that is a constant theme or drumbeat we hear in all recessions. The boogeyman is out there, and pretty soon nobody's going to have a job because robots are doing everything. Historically speaking, we have displacements in technology. But I believe what we will have is, I believe jobs will just change. And also jobs will move. I think that's one of the things that this crisis is going to show, is that some people have to move to find work. And that's disruptive, and I understand. But I don't think we have enough workers in the suburbs and all of those things. So it is certainly going to be disruptive. But I'm not as concerned. I think new industries, new things will come along. I think work will be there. Work, jobs, industry may be different. I guess I'm not as concerned about deflation because of technology. Maybe I'm just biased. Maybe I've just lived in the Silicon Valley too long and I've seen this talk for years. I guess I'm just not as concerned. Next, there was talk about what to do about giving a deposit back to a problematic tenant. When I read this question, this individual finally evicted or removed a tenant. That tenant was battling them, so it was not an easy process. And in this question, they basically said, can I keep their deposit? Well, you're free to do what you want. But I believe in doing the right thing always. I believe, if you haven't figured out, in good karma. So what I would do, and this happens to me several times a year. So first and foremost, my team would go in after they were out, and I would see how disruptive or destructive they've been. So these are the things that I would look for, right? Are there holes in the wall, right? That's not normal wear and tear. Second, have they been rough to doors? It's amazing how often tenants destroy doors. You know how hard you have to slam a door to hurt it? Or, it's amazing. So how hard have they been on my doors? Do I have to replace them? Have they been malicious to the walls? Have they let their kids draw on the walls? Have they cracked tile, right? Tile can crack by accident, but is it look purpose? Have they? What about the cabinet doors, right? Not only the bedroom doors and front and back doors, but what about the cabinet doors? If I can see signs of, I don't know what you want to call it, misuse or destruction, I will do a full audit, and that person who left will not get their deposit back. If you go in and it's just dirty and there's stains on the carpet, which happen in life, it's a very good chance, and there's none of that other stuff, I will just give them their deposit, maybe keep a couple of bucks for carpet cleaning or something, and just be done. So that's my thought. When in doubt, I do the right thing. But yes, I mean, there are people, there are tenants that are just mean, and they take it out on the property. And if that's the case, I will give them a full audit, and they would expect $0 back in their deposit. So that's my thought there. Next, people are saying, so is it a good time to buy? Right? This particular question was about New Mexico. So let me answer this question. I do not know your market. My opinion about New Mexico is the same as Memphis, as the same as Detroit, as the same as Miami. I have never looked. I have no idea. No idea. Second, my experience as being an investor, most of the people asking me this question are talking about owner occupation, right? They want to live there themselves with their family. My opinion means nothing there. My ability to research a market, look for cash flow, it's a different ball game. So my opinion about other markets should mean very, very little, other than if you want to know, I can teach you how to learn your market. I'm teaching hundreds, almost 1,000 people how to do it. It's working. They're doing deals. But again, I'm not going to answer a single question about another market except to tell you, learn your market. There you go. And then lastly, there were a couple of questions about 1031 exchanges. There were nuances, something about a Delaware corporation and another one selling California to out of state. I can only tell you my experience, and that's either good or bad. I do not get out of my lane. My experience with 1031 exchanges were going from houses to apartments, and then once from apartments to houses. But they were in the same market in Fresno, California. I do not know if there's nuances going from California to a Delaware-based corporation. Don't know why there would be, but I don't want to answer a question I don't know. And finding an intermediary that would help you go from California to out of state. Haven't done that, don't know. My answer for both of those would probably be go to Bigger Pockets and type in a question and see what happens. But I don't want to mislead you. A 1031 exchange is very powerful. I've used them, I don't know, 6 or 8 times. Very powerful. But I don't know the nuances of those questions. Okay, so those were all the seeded questions. I don't normally do this from my phone, so we're going to see if this works. I think I can go to the chat bubble here. Let's see if I lose everybody. Oh, this makes me nervous. Actually, I remember a few questions, so let me go there first because I don't know what's going to happen if I hit that bubble. First, do I think 30-year mortgages could go under 2%? I would say it's possible, not likely. It's hard to make money at that rate. Could it happen? Yes. Is it likely? I think it's highly unlikely to average under 2%, but I actually saw a 30-year mortgage at 1.99 already. So they're out there. Obviously, high credit, down payment, owner occupants, but I've already seen a 30-year mortgage at 1.99. So they're already out there. I don't think they average that, though. I mean, that would be pretty crazy. I'm really nervous about hitting this chat bubble. Let's see what happens. All messages are visible. All right, let's see. Oh, cool. All right, let's see what happens. Let's see. Ultimate bargains. Be sure to get signed move-in checklist. Yeah, definitely. Oh, look at that. I can scroll. How about that? All right, let me scroll to the top. See, I never done this on my phone before. All right, good morning, Paul. Thank you. Wawil, assuming a deal has a good yield, would it make sense to buy in a rising market or a market that's bottomed out? Ah, good question, Wawil. What I would tell you there is, again, as I tried to show you in an example earlier, I'm still doing deals today. I believe timing a market, looking for a bottom, you got to remember it's about payments. And as I showed you in the example earlier, a 350K house going to 300, but the mortgage goes from 3 to 5, you're actually losing cash flow. So again, I think there is, I'm still doing deals today. And again, you learn your market, you do a deal, you move on. I would tell you today, only do great deals. If you're one of my students, you know what that means. If you're one of my students, you look at your market, you spend 30, 60, 90 days, you learn it. What do I mean by learn it? Is you'll know what an average deal is. An average deal could be, say, 6%. Well, great. If you know what average is, and it takes time. Then what I want you to do is only do deals at 8%, right? If there's an 8% yield, do it, right? Don't worry about it. I think trying to time a market is tough to do, but it all starts with learning your market. Good morning, Rashad. Rashad, I don't know what that means, or a business owner. Did I miss your question? I don't see it. Tamika, as you study consumer behavior, are you noticing indicators of consumers moving from chronic consumerism to more savings and investment mindset? Tamika, I think that is a great question. And these are the subtle things that I think this crisis will teach us. As I've said months ago, I think this crisis is going to be different than 9/11, different than the Great Recession. We kind of came through those traumatic events and we went right back to normal. I believe what we are seeing today is life changing, generational change. I think what we're seeing with millennials is something that is very important and not talked about. I think millennials are showing us, and they have historically done this. If you look at the data, they are different than baby boomers. They are different than Gen X. This is important. They are going to be the thing that works through our economy the next 50 years, their generation. And they're making choices different than Gen X and baby boomers. They just are. They're getting married later. They're choosing work-life balance very different than you and I. So yes, I do believe the millennial generation is saving more. I believe they are making decisions that are very different than baby boom and Gen X. And yes, I am already seeing some differences. And I think those will change. Yeah, I think they will make a markable difference. We'll see. I certainly believe so. Theo, what are your thoughts on waiving escrow with an investor mortgage so you pay taxes and insurance out of pocket and principal interest paid through mortgage? I do it both ways. If the lender is going to let me save on interest rates or waive fees, I'll escrow money with them every month. But if they're not going to give me any savings, I choose to pay that stuff myself. Just how I'm wired. So in general, I do pay insurance and taxes myself. But there have been a couple of loans I've gotten where I got an eighth of a discount on interest, and I'll take the interest savings every time because I plan to own these for decades. So an eighth savings on interest rate is meaningful to me. So hopefully that helps. All right, folks, make sure you ask your questions because I'm actually finding a way to get this done. JC, how many offers do you make in a typical week? So JC, I'll answer that question today and historically. So in 2020, during this crisis, think May to November. I would say I've made 8 to 10 offers a week. I think a couple of weeks I made 20. I would say eight to 10 is average this year. I would say historically, it's probably more like 10 to 15. It's probably more like 10 to 15. And just so we know what an offer is, Sometimes that just means me calling the listing agent saying, hey, my name's, Michael Zuber. I buy a lot of stuff. I'd like to make an offer on 123 Main Street, your listing. I'm thinking this. I consider that an offer. An offer to me doesn't mean I actually filled out the full purchase agreement. It means I've had communication with the owner, with the owner's agent, with a wholesaler, with a flipper, and I've given them a number. So just so we're clear on what an offer is, that's an offer to me. All right, let's go back. Okay, JC's question. Kevin Chen, how are you? Just refined investment property. Wow, 2 3/4, 30-year fixed cash flow, 1K. Awesome. Congrats, Kevin. Everyday exercise. I just answered yours. I think it's possible. I don't know. If an investor income has been affected by COVID 2020, what would be a good real estate strategy for 2020? If an investor's income has been affected by what would be, I'm not sure what that question means. Let's go back. Hey, where'd the questions go? Let's go back. Sorry about this, folks. Janice, if an investor's income has been affected by COVID 2020, what would be a good reinvestment strategy for 21? Higher down payment. Janice, in that question, I don't know who the investor is. Is the investor the buyer or is the investor the seller? So I'll try to answer both. So maybe you're thinking, hey, there's an investor who bought a flip that needs to get out. They're in trouble. So in that case, yeah, you could go in and you can, try to take over payments, bail them out, buy at a discount. But if you're the buyer and your income has gone down, and it's going to be harder for you to qualify, debt service, all of that. Yeah, I think obviously it's going to be higher down payments. Make sure you can cash flow and be conservative. But it could just be about building your savings up again. You can always look for creative financing. So yeah, it's all those things. So I think 2021 is going to be an interesting year because again, I see 2021, we're going to come back out of this. If you watch my daily financial news videos, I think I'm generally positive about 2021 after Q4 pain, Q1 pain. It's going to be an interesting year. It's going to be fun to watch. Okay. SC. Okay, so that's that question. Braver Leach. All right. I'm a new investor who doesn't know anything resources other than books. Currently, I'm looking at real estate and stocks. Oh, your book resources other than your books would you recommend I look at? Well, again, you're brand new, right? YouTube University is great. I put out 3 or 4 videos a day. You can get lost in hours of content. Bigger Pockets is out there. Rich Dad, Poor Dad, Millionaire Next Door. There's all kinds of resources to check out. Okay, opinion, yep. Be sure to sign, yep. Kenny, good morning. What folks return back to cities or vertical residence once the pandemic ends and or situation gets better with the vaccine? What do you think? So Kenny, I did a video, I think it was Wednesday or Thursday, about New York and San Francisco. I actually did that with Jonathan Twomley, so that would be Thursday. He lives in New York. I'm closer to San Francisco. I don't think the rush back to urban living is going to be as big or as fast as some people think. As I said in that video with Jonathan, I think New York recovers first. I think New York has more going for it. It's more diverse. It's bigger. But I don't see people rushing back to San Francisco, for example. I think technology companies have said, get out. We don't want to have offices in the city. We are technology, so let's prove work from home works. Let's go remote. Technology companies are saving on headcount because it's cheaper to hire people in other states than the Bay Area. So yes, I think New York recovers pretty quickly. I don't think San Francisco does, in my opinion. SC, I know you talked about SF downtown, condo market trends. Any insight on San Mateo, Santa Clara County, suburbs, single family? It's really going to be work from home. I think generally speaking, the thing that we have, and again, I live in the suburbs of San Francisco, so realize, yeah, realize for what that is. I don't think we're going to have the huge run up. We are unaffordable. And I think over the next 5 to 10 years, we're not going to see the same people moving in that have historically been the next buyer of that $1.8 million 1950s build ranch. It's crazy. I think there's a lot of people that are looking at the high taxes in California and going, I'm out. So I think there's going to be I think we still have limited supply. So I think there's going to be artificial increases. I think like Los Gatos and Los Altos and Palo Alto will still see transactions. But I believe by next summer, they're not as great. But again, I'm an investor, not an owner. I would never buy an investment here. That much I can tell you. Do you make offers before seeing home in person? Yes, I invest in a market that's 2.5 hours away. I routinely make offers what I don't see. Counter offer seller giving 35 credit for. Hi, Stevie. I don't know what that's in relationship to, man. Sorry. All right. Okay, folks, I think I've caught up on all the questions. Any more questions? I actually made this work. How about that? I think I got all the questions. All right, folks, again, if you're watching, you can feel free to ask questions. Oh, we got another one. What do you think about Orlando, Florida market? Again, as I said earlier, I don't know that market. Do your own research, learn your market. I would tell you Orlando seems to be problematic as it has a lot of service industry, travel related industry, vacation spot. So it's going to have pain. Probably not as much as Las Vegas pain, but pain nonetheless. But yeah, watch the market, look for unemployment, look for forbearance, look for evictions. I believe a market like Orlando is going to suffer pain like Vegas, maybe not as much or as great. But yeah, I think, again, I can't predict other markets, right? Anybody who thinks they can have an opinion about 50 markets is probably not doing you or I a good service. I only know one market. I only look at one market 10 minutes a day. But I can teach you how to learn your market, and I'm teaching hundreds, almost 1,000 people to do it. So yeah, it's possible. All right, I think I got all the questions. All right, folks, sorry for the hiccup in the beginning of this. I'm glad we were able to do this from my phone. Glad I was able to go back and get your questions. Hopefully by next Saturday, we are doing this on the computer with a much more stable internet. I bought some more gizmos, like I said. All right, so here we go. Seller is giving 3,500 credit, possible, oops, cancel. Lost rent 6 month and eviction fee since they don't think they can remove tenant. So Stevie Wonder, I think what you're saying is you are buying a tenant occupied home and you're getting a credit, I think is what you're telling me. I don't know, Stevie Wonder. I today won't buy a tenant occupied home that's not paying. I will not do that. I expect eviction moratoriums and all of these things going on to be problematic. I don't want that headache. So not for me. I wouldn't do it. It's just too much trouble. Yes, Stevie, I see your question. I want to take over a house empty. That is definitely what I would look for. Oh, God, I'm glad you like my book. Just starting in real estate investing. How do I sign up for my course? There's a link below. You can go to onerentalatatime.com. It's there. It's $199. It's cheap. It's helping people. I'm very proud of it. And if you do buy my course, John, make sure you get added to the Facebook group because I go live with my students in about 9 minutes. Yep, I'm glad I stuck with it. How do you determine when it's time to trade, sell off rental property? Janice, as I highlighted in my book, I only sell when stuff gets overpriced. So in 2008, the affordability index told me. In 2019, the cap rate compression told me. So again, I pay attention. This is what happens, Janice, when you look every day. You can see what's going on and you can see artificial increase in price. These are all important things to watch. Learn your market. Look 10 minutes a day, every day, at least 6 days a week. I'll give you Sunday off. All right, folks, I'm going to call it there. Thank you. Sorry for the struggles up front, but I'm going to get off this so I can talk to my students in 9 minutes. Take care. Bye.